Losing a partner, it's absolutely crushing. Your whole world feels like it's halted. But something else begins. A timer. A 9-month timer with the IRS. And what most people don't realize about this crucial window can genuinely cost them everything they've created. So let's dive into what you need to know. This isn't personal tax or legal advice. It's a roadmap to discuss with qualified professionals in your area. This is general information that honestly every single person should hear, but almost nobody brings up. And look, this isn't just a made-up scenario. Let me share a real story about a 71-year-old widow in Pennsylvania. Her husband dies. They'd lived in their home since 1990. It was paid off. Everything looked okay. She figured, I'm fine. She didn't sell the house, didn't move a single account. But then 9 months later, bam, a notice from the IRS arrives. She owes more than $6,000 in charges. And the worst part, she lost access to a tax exemption that might have shielded over $13 million. All because she missed a deadline she never even knew was there. That's what we're here to stop. We're going to help ensure that doesn't happen to you. This is the number you need to lock into your mind. 9 months. The clock starts running the day your spouse passes away. And the IRS, well, they don't pause for mourning. What you do, or more importantly, what you don't do, in this short window changes everything. It's the difference between safeguarding everything you built together and watching a big slice of it vanish to taxes and penalties you didn't even know existed. Okay, so here's how we're going to handle this. First, we'll cover the 3 major financial traps to watch for. Then we'll get into the good stuff: securing your home, preserving your estate, and protecting your other assets. And we'll wrap it up with one final crystal clear action plan. All right, section 1. Let's dig into why this matters so much. It's not just one small issue. It's actually a perfect storm of a few different risks that honestly most people don't see coming until it's too late. So what are these traps? There are basically 3 big ones. First, you've got the IRS. They want a federal estate tax filing, or at least a deliberate decision not to file within those 9 months. Second, you've got your state. A lot of states have their own estate or inheritance tax, and guess what? Their exemption limits are way, way lower. And third, and this is a big one, are your own mistakes. Simple errors, simple oversights can trigger huge, completely unnecessary capital gains taxes down the road. We're going to break down how to avoid all 3. Okay, let's start building our protection. And we're going to begin with the biggest asset for most families, the home. This is ground zero for the most common and most expensive mistake, but it's also where you'll find one of the strongest tax breaks in the entire system. So there's a term you've got to know. It's called stepped up basis. It sounds complicated, but it's actually your best friend. This is probably one of the most valuable and most ignored parts of the tax code. Here's what it means in plain English. The IRS basically hits a reset button on your home's value. They act like you bought the house for whatever it was worth on the day your spouse passed away. All those years, maybe decades, of the house rising in value, poof. For tax purposes, that gain is simply gone. Let me show you what a massive difference this makes. Check this out. Say you bought your house years ago for $120,000. Now, on the day your spouse passes, it's worth $450,000. Okay? If you didn't have this step-up rule and you sold the house, your taxable gain would be a huge $330,000. But with the step up, your new cost, your new basis is reset to that $450,000. So if you sell it a little later for say $460,000, your taxable gain is only 10 grand. I mean, the difference is just wild. So what does that actually mean in your pocket? In that exact example, that one little rule could save you around $50,000 in taxes just from having the right piece of paper. One simple action can literally protect a lifetime of hard-earned equity. It's huge, okay? So how do you show this to the IRS? You can't just estimate, right? This brings us to action step number 1. You need to get a formal date of death property appraisal. Get a licensed appraiser out there, ideally within 60 days. It'll cost you maybe a few $100, but that report, that's your golden ticket. It's solid documentation for the IRS. This is something that wealthy families do automatically. Their lawyer just orders it. It's time the rest of us learn this move. All right, so we've secured the house. Now let's zoom out and look at the entire estate. This is where that 9-month clock really matters. And it all revolves around one single IRS form. So that 9-month clock we keep talking about, it's the deadline for something called IRS Form 706. That's the federal estate tax return. And right now you're probably thinking, wait, the estate tax exemption can be $14 million. I'm not even close. I don't need to file. And that assumption, that one thought, is a multi-million-dollar mistake waiting to happen. Here's the trap. You're thinking, my estate is under the limit, so I don't need to file. But here's the reality. Filing that form isn't about paying tax today. It's the only way to capture your deceased spouse's unused exemption and add it to yours. It's a concept called portability. Think of it like this. Your spouse has a $14 million coupon, and if you don't file this form, you just toss that coupon in the trash. It disappears forever, and you've just lost access to millions in future tax protection. Which leads us straight to step 2, and you got to do this fast, like within the first 30 days. You need to talk to a pro, a CPA, and an estate attorney, and ask them one question. Should I file Form 706 for portability? They'll help you figure it out. And if the answer is yes, you have to get it done before that 9-month clock runs out. Do not let this slip. All right, step 3. This one's simple, but so important. You have to update the title and deed to your house. You just need to take your spouse's name off it officially. Head down to your county recorder's office with the death certificate. It's a simple filing, probably costs less than a nice dinner out, but it will save you thousands, and I mean thousands, in legal headaches later if you want to sell the house or refinance. So let's say you've got all your federal ducks in a row. You're feeling good. You might be safe from the IRS, but are you safe from your state? This is the question almost everyone forgets to ask. Just because you're clear with the feds doesn't mean your state won't come looking for its share. And this is a huge trap. The federal exemption is, nearly $14 million. But states play by totally different rules. Look at Oregon and Massachusetts. They start taxing estates over just $1 million. And remember that widow in Pennsylvania, their state has an inheritance tax that kicks in from $1. There is no exemption. This is how regular middle-class families get blindsided. And here's the kicker. A lot of state deadlines are even shorter than that 9-month federal one. You got to stay on top of this. Okay? So we've covered the house, we've covered the estate, but there are a few more really critical details we need to talk about. Let's make sure we protect all the other assets you've worked so hard for. This brings us to step 4, and please do not skip this one. You need to do an audit of every single beneficiary you have listed. I'm talking life insurance, IRAs, 401ks, everything. And here's why this is so critical. A beneficiary form overrides your will. Let me say that again. It overrides your will. It doesn't matter what your will says. If you have an old 401k from a job 20 years ago that still lists your ex-spouse, they get the money, not your kids, not your estate. They do. Taking an hour to fix this can prevent an absolute nightmare for your family. And last but not least, step 5. This is one that can put money back in your pocket every single year. You need to call your county assessor's office. Ask them specifically about property tax exemptions for a surviving spouse or widow. Pretty much every state has some kind of program. It could be a reduction, could be a tax freeze. But here's the thing. They are not automatic. You have to apply for them. And if you don't, you could be overpaying your property taxes by thousands of dollars year after year. Okay, I know that was a lot of information, so let's pull it all together. Let's put it into one simple final action plan. This is your 9-month checklist, your playbook to get through this. Here it is. Super simple. Step 1, get that property appraisal. Do it within 60 days. Step 2, Talk to a CPA about that Form 706 and do it within 30 days. Step 3, update the house deed. Give yourself 60 days for that. Step 4, audit all your beneficiaries, another 30-day task. And step 5, apply for those property tax exemptions before whatever your state's deadline is. That's it. This checklist right here, this is the whole game. The difference between someone who protects their family's finances and someone who doesn't. It's not about how much money they have. It's about knowing these 5 steps. So I'll just leave you with this thought. You've spent a lifetime building something together. Are you prepared to protect it? The most important thing you can do now is make sure that legacy is secure. And please, if you know anyone who needs to hear this, share this with them. Don't let that 9-month clock catch them by surprise.